So we are live. Let's see if we have attendees. Okay, we have so the attendees numbers are counting. We have 2 attendees. Let's see if we have probably 10 or 15 more attendees, and then we start. Thank you for joining us in this webinar series. My name is Osita Egon. I am Regional Director and Business Development Manager at LaToken. LaToken is a digital asset trading and crowdfunding platform. We connect entrepreneurs and businesses with institutional and retail investors. I'm your moderator for this event, and I hope you do enjoy the discussions. The theme of today's panel discussion is aligning the role of policymakers to drive a positive ecosystem for fintechs across the globe. We have invited prominent experts and key thought leaders to share their views and thoughts on challenges faced in policy making in the financial sector, the economic impact of digital and disruptive innovations, as well as the needed partnerships to drive forward economic performance and financial stability. Before we dive right in, just to let everyone know, this is going to be a 90-minute panel discussion followed by a 30-minute Q&A session. And how the Q&A session is going to run is, just like we did in the last event, we are letting the audience at the end of this event to ask their questions live directly to the speakers. So if any member of the audience have questions, you will get the opportunity to ask your questions live. So please make sure your mic is working properly. And we have a very interesting handout for every attendee of this event. It's a magazine, a financial magazine, Financial IT Summer Edition from Mr. Principe, who is the publisher of the magazine. We will put the link for everyone to download the magazine at the Q&A session box. So I hope you really enjoy reading the magazine. Without further ado, let's really dive into today's business. And I would like to start with Mr. Andre, and we'd like Andre to share his views on policy drivers. Andre, policy making in finance is a complex task. Institutions are faced with a number of compliance issues and as well as changes in their legacy system. This could mean that innovation sometimes is slow and is even being halted. So can you share your thoughts and views on what are the challenges faced in policy making in the financial or banking sector, and how these policies at play are hampering development and innovation?
Sure. Thank you very much, and very good question. In general, I see that there are definitely challenges in terms of regulations, and I think these challenges sometimes become more apparent in developing markets rather than developed markets. And what we've been observing, that what is happening is that you see that for traditional players that are already struggling to innovate, and I'm looking in particular at banks, the regulations are very strict, and in general, this not only hinders their capacity to innovate, but also makes it overall more expensive, and also makes them relying more on their legacy system. And I will go a bit into the details later. On the other hand, we see a lot of minor players that they have less regulatory impediments. They have less stringent regulations because maybe they have less stringent licensing type of business model. But at the same time, then they are completely left out of certain economies of scales, because to grow into, let's say, to the next level, it requires a lot of efforts in terms of also capital investment. In particularly, I'm looking at issues such as in a lot of developing countries, local regulations require the entirety of the customer database and the processing of transactions to happen within that particular country. And whereas on the one hand, you have like countries such as South Africa, also Nigeria to a certain extent, Kenya, where the infrastructure also in terms of like, in terms of internet availability, data center availability is more developed. A lot of other countries don't have it. So for them, what it means is that they need to create from scratch their own data center. They need to invest a lot on infrastructure, a lot in technology. And that's really, really prohibitive in a world where today everybody's talking about the cloud and unleashing the potential of the cloud. For a lot of financial players in this market, this is counterintuitive. On the other hand, you have minor players, and I'm looking at smaller fintechs and general smaller financial service providers that might not have the same requirements, or somehow might lies in a sort of a gray area in terms of what are the requirements in terms of technology and in terms of regulations. So thanks to this gray area, they can thrive, but they can only specialize on one thing, and they do that one thing very well, but they can only specialize on that one thing. And when it comes to evolve into more, let's say, mature financial service provider, they often impair by very high capital requirements. So what I'm trying to say is that there are often contradicting policies that are being put in place. On the one hand, that they want to favor innovation, but on the other, that sometimes they actually hinder it. I think one interesting model to look at is the British model, where it's not a surprise that some of the most successful neobanks in the world, such as Revolut, Sterling Bank, you name it, have been created in the UK. And this is because basically the British Central Bank has embraced a sandbox philosophy, where fundamentally, as long as you have your minimum capital requirements, and as long as you have a basic set of policies and procedures in place, you're granted a provisionary license to operate, and you have up to a year, if not two, if I'm not mistaken, to comply with those regulations fully and to become fully licensed. So I think the word sandbox here becomes very important to any new development and innovation in developing countries, and in particular when it comes to policy making, where you need to allow a sort of a playground where players can test, where players can innovate without feeling sometimes too much the pinch of stringent regulations, because ultimately who is gonna pay the price of this lack of innovation is the customers. And those same customers are the ones that the policy they want to protect, but somehow they hinder them from accessing more innovative services.
And thanks very much, Andre. Mr. Chris, what's your thoughts on that?
Well, thank you very much, and good morning, good afternoon to everyone, and thank you very much for making me part of this panel, and hello to my fellow panelists. So, you know, we're really in a very interesting time, and I think that in a lot of ways, the the developed economies are going to be suffering much more going forward than the economies that are have been in growth mode. And I think a big part of that is that one, we haven't seen yet the economic impact that is coming. Okay, there's been a lot of work done by the governments and the central banks to assist many big companies, especially, and it's just really pushing things down the road. At some point, that assistance is not going to be able to be continued, and we're going to see a much different situation. I know from many of the upper management in banks that I know and speak to, they're all on very much a cash preservation mode. So that means reducing credit lines, whether you're a good customer or not. That means not making new loans. That means reducing even what people can take out of their ATM accounts. If you could take out a certain amount before, they're reducing it now because they're in cash preservation mode. They know that coming down the road, things like the bond market is just going to be unsustainable to a certain amount. They know that a lot of the investment that people are looking to make and that they themselves want to make are also going to be hard to sustain. So I think that we haven't hit the hard times yet, and that's one of the things. Now, what really also hurts the developed world is that there's so much infrastructure in place, right? So if you're a bank today, the heart of your banking systems, are now 15, 20 or more years old. And today, with the situation economically, there's no possibility that you're going to get approval from bank management to make any kind of investments, and no bank management wants to take a risk that they make an investment into newer technology and then something goes wrong, something doesn't go right. It's too big a risk for them, so they're not going to do it. But in other economies where they don't have that kind of infrastructure, I think we're going to see a real leapfrog effect where they don't have the systems in place that are so critical and so old as we have in most of the major banks, and they're going to be able to quickly shift to newer technology and take advantage of a lot of the ways that the financial community has resisted change, but needs to change and ultimately will change. Of course, they will be in front, and I think that that's a very important part. And I really believe that we're going to start seeing over the next year or so a real shift in some of the balance of power. Right now you have central banks that are basically just printing money without really anything to back it up. At some point that's going to catch up to you, and we're going to see that. So if you can do things today to be more cost effective, to be more efficient, the traditional sectors that people have always looked at as being safe, like real estate, for instance, is no longer a safe place to be. I mean, today, to own an office building is not a benefit, and it's a liability. You have just about every industry has people working from home. The bulk of them will not come back to working in one big massive office space. You have the same thing in industries such as if I owned a shopping mall today, and you can't look at those things if you're a financial institution or a lender of any sorts and say that it will be safe or it would be reasonable to lend to somebody who's got a huge office building, or somebody that has a huge shopping center, or somebody that has a chain of movie theaters. I mean, all these businesses are changing dramatically. So, where we always were taught, I was taught since I was young that, real estate is the safe place to be no matter what happens. I really believe that that's not true. The safe place to be now is going to be technology. And technology, while traditionally hasn't been a place where people have been invested in terms of looking at it as a safe place, they look at it as a place that can add to their business. Now, I mean, I think a lot of that has changed. I think the only traditional investment out there that you can look at are precious metals like gold, which will hold their value. But I really think if you start looking at many of the big companies and the bonds that they traditionally issue, and those bonds are constantly rolled over, so the principal is never paid. I mean, today would you as a person or as a fund, would you want to buy the bonds of an airline if they're due? It'd be hard to say that they could pay the principal, much less the interest. So when those buyers stay away, what's going to happen to those bonds? And they start defaulting, that's going to fall back on the holders of the bonds, which will then fall back on the banks. So I think we're going to be looking at some fallout from this that we haven't seen yet. And that's where technology can really play some role in being an enabler for efficiency, be an enabler for cost effectiveness, be an enabler for keeping things together even, and I think that's something that we're going to see. So I think we'll see that technology will be one area where there'll be some investment, but I think it's going to be really, really tough in the near future for people to get investment. There's just not going to be the money out there as right now. Most companies who are not doing well, and there's certain industries, of course, that are doing well, but most companies are right now depleting their cash reserves, and at some point that's going to be a serious situation. So really, I think that the future and the exciting part of everything is what we're going to see in the developing world, because I think that they're going to be able to pivot quicker, move faster, embrace new technologies faster. And I think one of the things that has been a roadblock to some extent has been compliance and regulation. And we're even seeing in that area, a lot of the regulators I talk to right now they're understaffed, they're overworked, they're not able to keep up with it. And there's so many governments that have a lot of regulations on the books which don't suit today's world. I mean, there's still, for instance, if you want to, in a lot of places, if you want your company to open up a bank account there, the bank still requires you to be there in person. It's ridiculous. It's just, you're putting, not only the customer at risk, you're putting your staff at risk and everything else. So it's we really need to see some quicker change there. But again, I think that regulation in general is there's just not enough staff to go around. There's not enough things to work on, and in some ways that creates other opportunities. And those opportunities are going to be, where they're going to focus on who's really serious violators and give a little more freedom to the innovators. So I'm really excited about that part of it, and I really think we're going to see a lot of great innovation that comes out of this, and really, a new style of life and work that we were going towards, but the COVID-19 situation and pandemic and crisis has pushed it much quicker, much faster, and I think that's going to be a benefit more than a drawback in the long run.
Thank you, Chris. Before we move on to the next question, I think I was kind of a bit ahead of myself. I didn't ask you guys to introduce yourselves. So I might kind of ask you, Chris, to quickly do an intro before you take the next question.
Okay, yes. My name is Chris Principe. I've been an international banker for a big chunk of my career, specifically in international trade and finance. I've worked for a number of billion-dollar software companies, running business units for them. For the last 10 years, I've been consulting, training banks. I have some online banking courses. I publish Financial IT magazine, which really we strive to be the voice of the FinTech community to the banks, rather than most publications where it's the other way around. And with I also own a couple of software companies, so I'm very much involved in trying to see some of these changes happen. And for the last few years, I've done a lot of public speaking, which of course right now I've had to shift some of that to online, and some of it just may never recover, because I don't think we're going to see events happen in the same way and as many as we've seen in the past. So I kind of miss that part, because I do enjoy sharing with other people and hearing their questions, and I always feel that I'm the one that ends up learning the most. So that I miss already. So
thank you.
Right now, I'm speaking to you from my backyard in Florida. It's a beautiful morning, quite green, and this is pretty much where I've been working since March. So online has been, really the savior for me, and we've of course been using a lot of this stuff for years. But now to be 100%, pretty much 100% dedicated to it, I think is really amazing.
Thank you, Chris. I think the Financial IT magazine is going to be an interesting read, and you've shared that article with the attendees in this event. So I think they have the download link to download the magazine. And moving forward to our next question, Chris, given the challenges that policymakers are facing, what should policymakers be doing to address so many of those challenges?
Well, I think it's pretty simple. I think that we need to have a drastic cut in the amount of red tape and regulation. We need to have a very open mind to innovation, and I think there needs the ability to break from a lot of traditional models and allow the innovators of today to bring in some new models for us. And one of the biggest holdbacks is regulation, and particularly old, outdated regulation. So, for regulation, I've been an advocate of this for years anyway, that we're overregulated in general, and I think that there's good reason for this in terms of financial crimes, but I think that we're also look at reasons that are sometimes political, sometimes reasons that are to the advantage of the institution rather than the customer. So I'd like to see that we see some quick slashing of some of these onerous regulations, and really some implementation of a venue where innovators can actually help us progress to the next stage.
Thank you. Now I'm just going to move to Rosemary, because I don't want to take your time. I know you have some other issues to attend to. So Rosemary, before you take the next question, can you quickly introduce yourself to the audience?
Good morning. I just figured I should say that Chris is sitting in the nice sunny Florida. And good afternoon to the attendees and my fellow panelists. My name is Rosemary Kimaku. So as Chris was speaking through his experience, I was like, wow, okay. At least my only benefit is I'm getting to the gray hair zone soon. So I have about 10 years experience in technology. I mostly worked in the telecom space. Business technology was my main focus, and I recently moved to financial services. I thought this was an interesting space, painfully untapped, I must say. Currently running the digital banking business for Cellulant. It's a payments company that's present in more than 10 countries in Africa, and is at the pinnacle of, the blow up of the developing countries, the emerging markets in technology. So I'm glad about my timing, and I'm actually really glad about the timing of COVID, because it's really allowed me to stretch my mental muscle. So thank you for having me on the panel. Yeah. Sorry, Asuta, I think you're on mute.
Oh, I didn't realize. I'm sorry. Okay, thank you, Rosemary, for that quick intro. And before we move in to your question, I just want to say, it does seem as if the incumbent banks are alienated when it comes to topics relating to fintechs, and yet they operate several of these fintech-related products. But I would like to hear your thoughts or view. Who are fintech game changers, and what are their roles and responses to the growing global financial challenges?
So I actually was thinking about this question as it was posed to me, and I wondered really if we would particularly place fintechs as game changers. I think fintechs came as a result, or were born as a result, of the bank's inability to quickly move and adopt technology. So there was a gap. There was a very clear gap because, as you said, incumbent banks knew how to do business the traditional banking way, brick and mortar, lending money, collecting interest. And that's what banks knew, and that's what they were comfortable doing. And when the onset of technology, or the requirement on technology, started to come through, banks were very cautious and painfully risk averse. So they preferred that somebody out there who's experimented, who's willing to take up some risk, tweak some software, try it out, make sure it works before they agreed that this could be integrated into their systems. So that has mostly sat with the traditional banks. There were quite some big banks who over time realized that they need to adjust to the technology normal and have slowly adjusted to it, and are building more capabilities of financial technology. But it remains that smaller companies, more technology different, innovative, have a higher risk appetite, continue to partner with banks. But in my view, I think the guys who are changing the game are what we call the tech fins. So tech fins essentially is the opposite, that the guys who were doing technology and then now want to move to financial services. I'll give a few examples. So if a lot of these tech fins are Amazon, Facebook, have started off their journey in the technology area and addressing a very seemingly nuanced behavioral interaction of people, social commerce. They look at your lives, they interact with your lives, they see what you do every day. So from that knowledge, they've come from a very consumer intimate interaction, and now they pretty much know where are you spending your money without your own, advanced knowledge in the area. So if you think about a typical day, if you spend your time in the morning logging into Facebook and you check in your time, you check in your location, you inform your social media of choice where you buy your coffee, you show that you take the train or you drive to work, you map your Google location to that. You get to the office, you log in online, you spend your time in the office. You're pretty much exposing your behavior and interaction, your purchasing patterns to a technology firm. And now these technology firms have realized, wait a minute, I know the behavior of this person. I understand what their needs are from their various interactions. So I just need to get to where their money is. And because of this, they are much more astute to where consumers are spending, as opposed to traditionally where you put your money in a bank and then once you remove the money from the bank has no clue where you go. The tech fins are doing the opposite, is that they know your lifestyle, they understand exactly where you're going to spend your money. So they influence your purchasing behavior, either by targeted advertising or giving you a very convenient, user-friendly payment experience for the items that you interact with. And I think COVID has really accelerated that interaction. Now, more and more people have absolutely no qualm ordering something online. I know e-commerce is big in developed markets, but if you look at the emerging markets, if you look at Kenya, Ghana, Nigeria, and South Africa, that are the biggest markets, e-commerce was not great. Jumia, that was hailed as such a big e-commerce company, was generally struggling in Africa, and the IPO was big, but somehow the ability to just influence the consumers to go in that direction was taking some time, much longer than what you would expect. But what has happened now, if I can't leave the house, I can't go to the supermarket, I'm deathly scared, and I'm not American. Americans are just complete opposite of everybody else. I'm deathly scared of leaving the house. What will I do? I'll be forced to go online and shop. I'll be forced to go online and chat my friends. There's very interesting apps like House Party that have come to replace the clubbing scene. There's a lot of things that have happened this time that now have made people realize that, do I really necessarily need to keep my money in the bank and move money and interact in the bank? Or if my payment experience is entrenched in my lifestyle and the touch points that I am interacting with, that you barely notice how you spend money. And I think those are the game changers. I think those guys, if they get the right footing, obviously because different markets have different regulations, so they are able to move faster because they don't have to jump the hoops and loops that typical banks have to do to introduce new experiences to customers. They don't have price limitations because they're introducing a very new, nuanced service that a customer has not experienced before, and you're paying for the convenience. You're happy to spend your money. And I think those are the guys who are going to give a run for the money to the typical traditional banks. And as we go along, you realize that it will be important now that it is a matter of collaboration for everybody to be able to exhaustively handle a consumer. If you think about where the banks are at today, as Chris was mentioning earlier, obviously, naturally, a bank will hold on to their cash. They've been forced to give moratoriums for loans that have traditionally earned the bank's money over the years. Now, as a consumer, if I have a good credit score, I am still receiving an income on a monthly basis. And yet when I go to a bank for a need that I genuinely have, the bank, for obvious reasons, will decline my loan application. How much longer will I keep my money in that bank? And as currency is becoming more and more virtual, that I don't have to hold on to cash, what's the value the bank is bringing to me as a consumer, to me as a user? If you think about the regulatory aspects of that, traditional regulators have always known to regulate traditional businesses, banks. They're not necessarily hiring young people who come straight out of school and build really cool, mind-blowing technology. And those are the people who need to be sitting in regulation because they know where it's going. They know where the future. So as opposed to necessarily policing the people who are breaking the rules, is to figure out how do I create an environment that creates innovation and economic growth for everybody. At the end of the day, is that because when things go wrong, the government is the one that's handing money to bail out the businesses. The government is the one has to figure out how do I create an economic stimulus in my country? The government, at the end of the day, the buck stops with them. The government is the regulator. So I think what we need to watch out for, including myself, the tech fins that are coming up, they have a lot of wiggle room to explore, to understand consumers. and they are driven by data, and data does not lie. So for me, I think that is the place we need to watch.
Thank you, Rosemary. Well, quite interesting view that you shared with us. And so let's move on to Declan. Declan, before you take the question, can you quickly introduce yourself?
Thank you, Sita. And like I said, it's a great pleasure to be part of this event once more. This time virtual for obvious reasons, and to see great speakers like Chris and others. So my name is Declan Magero. I'm a founding partner at Afrinet Capital, which is a Pan-African venture capital platform focused mostly East Africa region, and mainly also focused on tech-aligned companies. So besides founding Afrinet Capital, I've worked extensively in the startup and entrepreneurial space in Sub-Saharan Africa, and also with very non-traditional sort of entrepreneurship sort of models with academia, with government, and also, you know, international NGOs and civil societies. Yeah, so that's pretty much Declan. I also sit on the advisory board of a couple of other companies, including the Lawyers Hub, and I am based in Nairobi, but we also run an office in New York.
Thank you, Declan. So my question is on collaboration and strategies. What type of strategies and collaboration between fintechs, legacy banks, and policymakers are needed to help drive the next phase of healthy economic performance and financial stability globally and regionally?
Yeah, thank you, Sita, for the question. So I think this is the pretty much biggest deal, and we're at such a place where we have to pretty much change models for engagement as far as, for instance, financial services are involved. And one of the things that must happen is there has to be what I call sector collaboration. And this is, there's a term collapitation, which is collaboration competition. So I think traditional models are pretty much based on competition, trying to raise the bar for market entrants, you know, trying to sort of have products that, you know, capitalize or monopolize the entire value chains and markets. But since invention is that hard, it's very hard at this moment to sort of come up with such novel products. And what that pretty much paints is there has to be a different model to this, and that is a model that, you know, is based on collaboration. And this is not only because of, you know, like profitability, which is at the base of, or the objective of most companies, but this is because there are other critical factors to human welfare, for that matter. For instance, human rights and issues like this. So there are other social factors that are really critical for the general well-being of society. So the sort of model and approach has to be totally different. So there are a couple of players, of course, government, there are private companies like Cellulant, etc., that are involved here. There are civil societies, there are startups for that matter. So each one of these pretty much plays a different role. And one of the critical elements is the regulatory structure. The government this is chiefly the responsibility of the government to come up with you know, regulatory structures that favor, you know, the markets. And initially, most governments were a bit hesitant or even resistant, you know, to come up with regulatory structures that are favorable to markets. But we have seen in recent times that most governments, especially in Africa, are willing to have conversations and are willing to come up with policies that ensure, for instance, protection of customer rights, for instance, as far as data is concerned and exploitation is concerned, or protection of borrowers, because, for instance, we've seen a proliferation of predatory lenders, especially mobile lenders in Africa. In Kenya, for instance, there are hundreds of them. So we've seen the government noticing that there's need to collaborate and come up with policies that are favorable. And even one of the policies that is being discussed currently in Kenya is digital taxation. How does the digital taxation as a regime plays out in the digital space and digital platforms, given that most of these companies are not even incorporated in some of these countries. So that is one critical aspect. The sort of regulatory structures have to be one that is collaborative and participative to include everyone. The other bit is most legacy systems and businesses like banks, traditional banks for that matter, have to change their models, that's for sure. And for instance, what COVID is proving is that technology does not need to be an alternative strategy to a company, but an integral one. And so digital products, for that matter, for instance, digital lending as an adoption by legacy systems and banks is something that has to happen now. And most of startups are the ones that are pretty much advanced as far as this is concerned. There's no cause for, let's say, banks to reinvent the wheel. All they need to do is collaborate with, fintechs and tech firms that have come up with great products. So that means there has to be some sort of trade-offs that happen across the board. And this is not only within jurisdictions or in country, it also speaks to sort of cross-border trading and elements such as interoperability, etc. So that means a collaboration even with big players, infrastructural players like telcos and others in terms of infrastructural integration. So this is a very complex network because it goes as much into things like regional policies. One key problem in Africa, for instance, is the issue of currency. If you go from one country to another, jurisdiction to another, you meet different currencies, and there has to be some kind of exchange that happens. This makes trading really, really difficult. And before you exist in a market or you exchange across the border, you really need to think through what this currency volatility, how this will actually impact your business. So these are some of the things that need to be, harmonized so that there's not too much fluctuation, which would affect trade as such, to make markets like Africa a little more dependable and a little more stable. But in terms of coping with crisis, I think this sort of markets also present like serious opportunity. And from where I sit, I've seen huge capacities for companies to spring back. Some did not feel the dent at all. They were able to transition easily. Actually, for a couple of companies within our portfolio, they think, for instance, remote work saves them quite a bit of asset in terms of things like office rent and issues like this. So this crisis is not, for instance, necessarily a bad thing. It has accelerated, for instance, adoption of digital products, and has also accelerated some business models that are a little bit difficult or finding it difficult to access certain markets. So that element plays out a little bit here. So other critical things that are crucial are things like, I know we've been talking about concepts like inclusion for quite a bit, and these are things that need to be expedited in order for, let's say, the markets to just perform fine in the future. It doesn't help anyone if a critical cadre of, let's say, the society is not included in the financial sector, or cannot access critical financial services and products. The general access by all is actually great for markets as we speak. And I think an African perspective is quite interesting, and Kenya for that matter. We've seen some interesting moves by players recently. Government, for instance, and Safaricom that runs M-Pesa, they've changed a little bit the sort of transactional fees for, let's say, money transfer, and even the limits in terms of volumes. And this has pretty much expedited payment processes, it's expedited commerce and things like this. So in terms of, as I close, in terms of strategies, I think the first critical thing is it has to be a collaborative exercise to improve the general well-being of the ecosystem. And that demands change of regulatory structures to suit the times. And the other bit is, adopting technologies as integral part of systems and democratizing that, so that we can promote access to technology platforms by, for instance, reducing the cost of technology, cost of internet and things like this. Promoting, interoperability and structures across the board, so that this harmonious exchange of products, services, etc. And generally, the collaboration should be not only between big players like banks and government, but also including, let's say, startups, which are generally smaller players without too much muscle, but highly innovative, but also adopting interesting business models that can be, can generally be useful in terms of promoting, let's say, access of platforms, access of digital services and products for all. So I think these are some of the critical things that have to sort of happen in order for everyone to survive. Yeah, thank you.
Thank you, Declan. And Pedro, before you share your thoughts with us on that, can you quickly introduce yourself to the audience?
Let me just unmuting. Are you able to listen? Yeah, to hear me?
Yes, we can hear you.
Perfect. Very good. Thank you for inviting me to participate. It's an honor. I'm the executive chairman of Banco BNI Europa. Banco BNI Europa is a subsidiary of a bank in Angola called Banco de Negócios Internacional, based in Luanda. And this subsidiary has existed since the middle of 2014. And at the end of 2015, we started exploring ways to bring more revenue to the subsidiary, apart from the typical correspondent banking activity that the bank was already doing. So we actually converted ourselves into a challenger bank by benefiting from the FinTech ecosystem that was actually evolving and growing over the last few years, and try to focus the bank on niche markets to allow us to have space to compete, as the market in Europe, as you know, it's overbanked and with negative interest rates, it's quite a challenging environment to have a startup bank flourish. So that's basically what we've been doing in the last few years. So, Osita.
Pedro, thank you very much. The question is, what type of strategies and collaboration between legacy banks, fintech, and policymakers are needed to drive the next phase of economic performance and financial stability?
Very good. I have actually a presentation that I could share, but I see that my screen sharing is being disabled. I don't know to what extent that is possible to enable it.
I'm not sure about that. Maybe the host can comment on that. Innovation World.
I don't know if they are able to, because it would be much simpler if I could share a presentation on strategies and collaboration.
Hi Pedro, we do not have that option, where I can give you that access here. I'm just trying to check if we have that option. In the meantime, if you can just quickly mail, then I can also share from my end, if possible.
Mail it to you.
Yeah. So I can just share that, and you can just do it, because I do not find that option over here.
Okay. Let me quickly email, and then I will do it anyway, verbally.
Okay.
I will send it to which email?
Anyone, anyone. Yeah, that will do. Yeah.
Okay. Okay. Insert file. Okay, I've just emailed it. Very good. I will speak about it anyway. So basically, I wanted to share with you a presentation about some effectively business strategies that one can consider when looking at the different businesses that we have seen now when banks or other institutions are planning to be digital or are trying to effectively bring more innovation. So I would speak first about our business model at BNI Europa. So BNI Europa, as I mentioned to you, started basically relying on the cross-sell between the parent and the subsidiary by having correspondent banking activity. But we soon realized that was not enough. So we decided, number one, to become a digital bank, so no branches. Number two, to focus on niche products, which we would have some sort of access to clients that the incumbent banks were not really focusing on this segment or on this type of product. And finally, try to the extent possible, to develop solutions, not necessarily in-house, not all the solutions, but eventually rely on this fintech ecosystem that was about to grow quite fast. So a couple of examples on this topic is, number one, technology. I do believe that nowadays there is no need for any financial institution to actually develop the full stack of technology from scratch as it used to in the past. Obviously, they have their core banking system, but then they use all the interfaces and all the other applications. They usually contracted an IT company and they would work together to try to find a solution that was customized to them. Nowadays, we see across different areas, whether it's on the sales side, accessing clients, getting a better customer experience, identifying the client, whether it's in the compliance area, AML, etc. We see more and more alternatives, which is plug and play. Basically, obviously, there might be some changes on what concerns regulation from country to country, but we see an explosion of solutions where we don't actually need. Oh, there it is. Okay. But I'm not able to. Yeah, maybe I can ask them to pass on the slide. Maybe you can go to the next slide. Yeah. So as I was mentioning, so we have seen an explosion of technology solutions, but that is not the only case. We have seen also in the business side, fintechs, they can be complementary to the business of a bank. So I'll give you a couple of examples again. So we have decided to team up with deposit originators. So we are a bank based in Lisbon, Portugal. And we initially started in order to diversify our funding needs to obviously grow our term deposit base in Portugal, but we soon realized we could address other markets as big as Germany. And so we teamed up with a couple of fintechs out of Berlin, and we managed to grow our deposit base from Germany, Austria, and Holland, and diversified obviously in these geographies. Then another good example is, since our internal projects took quite a bit of time, we actually started thinking about how to grow our credit portfolio quicker. And one way to do it was actually to look at the peer-to-peer lender or marketplace lenders that were starting to grow more and more across Europe. And this is a phenomenon that started in US, China, Europe, and other markets, as you know. And we have relied on a number of these originators for SME loans, consumer loans, or invoice financing. Those are the three main verticals, I would say. So this allowed us as a bank not to wait for our credit portfolio to actually grow depending on our own success of our direct channels. Simultaneously, we obviously grew our own products. So we have an offering on the consumer credit side where we guarantee that the client can do everything from onboarding all the way to the disbursement, fully digital. So we managed to identify the client, we managed to get the information for the purposes of doing the credit scoring. We proposed the terms and conditions to the client. You can sign the contract digitally, and finally we can disperse to the client. So we were the first bank in Portugal, one of the first in Europe to manage to do this fully digital. And as you can see now in this COVID world, this is quite a tool because you don't need effectively not even to have a call center. Obviously, sometimes the client might have some complexity or difficulty in going through the whole process. Obviously, there is a support line through a chat or through a call center effectively. But in that particular solution, what I can alert to you is that technology has been applied from different partners in the different value chain. So this means that we did not create a technology on identifying the client is faced with an ID. We had that. We didn't do screen scrapping ourselves. We got a company that would extract the information from their home banking, wherever they were banking with, and so on. So we actually have tools in the different parts of the process which we would rely on. This model has proven to be a good one because it diversified obviously our risk across Europe, and it made us grow without relying solely on our IT team. So that's quite relevant. We can go to the next slide.
Excuse me, Pedro, sorry to cut you off. Rosemary would like to take a leave now. Rosemary, I want to thank you very much for taking out the time to come talk to us. And we do hope that we'll have you on the next event.
Thank you so much for having me. Thank you to the panelists. Great meeting you all. Hopefully we meet next time. Cheers.
Thanks, Rosemary. Bye-bye.
Bye.
So, I mean, talking about new business models, as you can see, we created some sort of different model, and I'll tell you where we fit. But let me talk to you about what we consider are the new business models that we see more and more in order to approach the digital banking world. And this is evolving, obviously. This is not like it's a given. We will see some of these models becoming more prominent. Please go to the next slide. So we start with what we call the renewed model. Obviously, this is a typical model for banks that see that they are being challenged by competitors which are becoming more agile, and they need to do something in terms of digital. So they start by accelerating their digitalization. They usually concentrate on the front end by providing customer experience that is more pleasing and more easy than previously, and try to do the best they can with the infrastructure. When I say the best they can, because typically the level of infrastructure these institutions have does not allow them to do a huge leapfrog on technology, because they have legacy systems. So they may be able to have an interface for a front end, but then in what concerns middle office and back office, and even the core banking system, they have to rely on them. And they also have to rely on the current human infrastructure. So processes are not challenged, and people used to do business the way they did before. So the culture is not really adapting to this new world. So this means the client might have a new front end, but the moment he starts interacting with the bank, then he sees this back again to the old world. So these are really key challenges for someone who wants to just revamp the business. So it has to deal with all the challenges of legacy issues that I mentioned. We can go to the next slide. Then we have the fragmented model. So the fragmented model, in a way, I could say it's similar to the approach we took. So one bank can decide on particular segments to actually plug in some solution that is provided by a fintech, whether this is a portfolio management, for instance. If you want to provide to your wealth management clients solutions that are more automated, maybe you can basically try to carve out a segment and provide that tool to them without having to interfere with your systems and maybe create a separate team. Other opportunities are, like I mentioned, working with the marketplace lenders. Let's say I have a segment, the SME segment, which I'm not providing good service, or I don't even look at the credit opportunities. So I provide the opportunity for a third party to actually analyze those leads that I bring, and then they will treat them in a much faster way than my team would probably do. So there are more and more examples like that that eventually financial institutions can do, but they actually do it in a particular segment or in a particular part of the value chain of the bank. So we can move on to the next slide. Then it's the startup model. Obviously, this is the more radical model. It's when one realizes that the best solution is to start completely from scratch. So if you have the benefit of having either a financial institution that wants to create a separate entity, or a startup with VC money, that certainly brings us the ability to have a clean sheet of paper, select the best core banking system, select the best tools, find the best workflow solution, the people that are more familiar and with the culture that allows us to interact with the client in the best way. And as you know, the banks that start from this way, the digital banks effectively, it's normally the case that there is a large part of the contingent is actually IT related people, consumer experience or client experience related. So they focus very much on one hand on the client feedback, and on the other hand on developing solutions that target exactly the client needs without any legacy issues. Obviously, the drawback is that you need a large investment, you need to capture a large group of clients in order to become profitable. So it's not obvious that you will eventually become profitable and successful. We have seen a number of cases like the ones mentioned on the slide where these banks are still growing and they still have not reached profitability. So obviously we will see now in the near future whether some of these banks will be able to stand on their own or whether they will be basically bought by existing banks which already have their own client base. So we can move to the next slide. Then there is the invisible model. So what is the invisible model? It's effectively a model whereby a bank decides to provide services to non-banks, so to entities that don't want necessarily to be a bank, but they do have the ability to cross-sell. So let's say an airline, they might want to provide a credit card business, but they don't want to have to deal with all the licensing and all the issues around it. So there are a number of examples like that. So nowadays, we see in certain cases banks trying to provide some sort of the benefit of the banking license to clients of other entities, and basically share the economics with these entities. And we basically become an invisible bank where we don't necessarily have to show ourselves as the brand name. So the brand can be someone else. Obviously, the client ultimately might know who the bank is behind, but we see that this could be a great opportunity for a number of banks that struggle to get fee income. And if you provide different types of services across a number of sectors, and we see now even some of these banks specializing in certain verticals, I would say there is a good future. But this, obviously, it's a model that cannot be, obviously, a mass model. So it is a particular segment within the strategy that you can approach. It has a low operating cost, as I can say, and the IT platforms are well prepared to onboard this type of client. So it's typically a B2B2C model. So we can move on to the next one. Then there is finally the no bank model. So everyone is concerned about the Amazons of this world and the Ubers of this world. And we see now more and more Apples and Amazon, Google trying to enter the financial sector. This type of big techs, these giants, don't necessarily have the willingness to be regulated. You know, as you know, regulation is very heavy. So they are trying to, for the time being, to find some sort of business models that are not necessarily regulated. But over time, I would say we will see more and more of these companies, obviously not only big techs, but big techs are the obvious ones, but the use of this data that is gathered by a number of these big techs and also fintechs, like the ones mentioned on the slide, to bring clients and to allow the best experience to the client, but not having to deal with the regulatory issues. I would say from a threat point of view regarding the incumbent banks, I would say this would be the biggest threat. We will see more and more the no bank player playing a role in each country and try to offer alternative solutions, bringing basically opportunity to the client and trying to disintermediate the banking business. Let me give you a very simple example. We see now more and more that the typical traditional mortgage business used to be done by banks. It was actually an anchor product to allow the client to basically sell more or cross-sell more products into that client. The moment you have the mortgage with a particular bank, you bring your wage, also you buy insurance products, you bring your savings, so you end up buying quite a number of products. Now we see that number one, there are platforms, aggregators that basically allow you to choose the best mortgage possible in the market. So the loyalty is no longer there for these banks. Number two, there has been a pressure from the regulators to unbundle this type of products in order to bring more transparency. So that's another pressure banks have. And finally, we even find entities that are originating clients and booking the mortgage directly into an insurance company book in the balance sheet. So this means that you effectively don't need a bank unless you really consider that banks have a lower cost of funding. Therefore, there is some advantage. But if other investors, institutional investors, are willing to buy these mortgages, obviously the bank is just another intermediary, where before the bank used to have originating these loans and eventually then disintermediate these loans by creating a securitization and selling the bonds to investors. But we see now these type of models being challenged. So what I'm saying is that the no bank model, depending on the regulator in each country, can become more and more of a challenge. So banks have to really revisit their model, and instead of having a more of a universal model, like is usually the case, to actually rethink their business model and maybe focus on the areas where they are stronger instead of trying to cater for every type of client out there. So I would say that that is the real challenge. We can move to the next slide. So that's it. So thank you for your attention, and that's what I had to say regarding this strategy.
Thank you very much, Pedro. That's Pedro there sharing with us the strategies and collaborations needed to drive the next phase of a healthy economic performance. Now, I'm going to move quickly to Andrea, and I would like Andrea to talk to us on economic outcome. But before we do that, can Andrea quickly introduce himself? Quickly.
Yes, thank you, Osita. It's in fact, in my previous question, I forgot to introduce myself. I've been working in the banking sector in Africa for 9 years. In particular, I was involved in a lot of digital transformations projects. And recently, I become an independent consultant, and I'm doing private consulting in the fields of e-commerce and SME banking. So yeah, that's a bit about myself, and yeah, I'm happy to answer your next question.
Thanks very much, Andre. So this is probably going to be the last question in this webinar. And my question is to you, Andrea. What are the economic impacts of digital banking and disruptive innovations? Are these features of financial system that appear to make it more susceptible to financial instability? Are there features of financial systems that appear to make economic impact susceptible to financial instability?
If I understand your question correctly, you're asking me if these new digital systems can create financial instability overall. Well, yes and no. It's a quite of a complex question. I think if we look back at the history of let's say digital finance, digital banking, in particular in developing markets, there have been cases of technology creating financial instability. I think a very old one was, if I'm not mistaken, back in 2011, 12, where prominent mobile money provider in Uganda had, let's say, a fraud or a glitch perpetrated on their systems, whereby basically overnight something like more than $60 million were created, to a point that the inflation even went up 0.1 or 0.2% just overnight. Because for anybody who is familiar with mobile money system, you know, can imagine that in the early years, like when the reconciliation was, if not done properly, you could basically create electronic value that then could be translated into actual cash value through cash out. So that was like a very famous and prominent case that happened back in the years. But I'm also referring to more recent, to the more recent and very famous cases in Kenya, where for example, you have a lot of people that are basically making use of digital lenders and making use of these automated super fast loans. And basically they enter into some sort of a Ponzi scheme where they basically keep borrowing from each and every new provider that appears in the market to pay for the loans that they have on the other providers. And as much as in Kenya, like the credit bureaus are very developed, soon, if this issue is not tackled, there will be a lot of problems, and there are actually already appearing a lot of challenges in this regard. So in general, there are cases of where new technology and new services have somehow created, also they've opened up new loops, and they open up new risks. But in general, these are pretty much a drop in the ocean. And keep in mind that oftentimes the bad cases are sometimes more remembered than the good ones, because that's basically, those are the basics of human psychology. But overall, like the impact of technology on markets has been incredible. In particular, I'm looking at a developing market where most of my experience has been based in the past few years. And when we look at indicators such as financial inclusion and overall financial and business literacy, they've all improved exponentially, and the technology have only had a tremendous impact on so many lives. And it also allowed, particularly during these challenging times, it has also allowed those providers that had digital channels to survive. And unfortunately, this would be kind of like the divide that probably will set forth a lot of businesses in the future. Like those with digital channels will survive, and those who don't will not. In a completely different sector, but I just read this morning on the CNN that a prominent and famous business worldwide, such as the Cirque du Soleil, filed for bankruptcy. And of course, how can a circus survive without their audience? So I think we've just seen now the beginning of how really technology will be the norm in the future, and would really those businesses that will able to reinvent themselves digitally will be able to survive.
Thank you, Andre. We're now moving to the Q&A session, and our first live speaker will be Charles. Charles, hello, are you there? Hello, Charles. Charles. Okay, so it seems Charles is not able to speak. So I'll just read out his question or comment. He says, I run a digital factories for FSPS, banking and insurance. And he says it takes from 3 to 5 years to become fully digitally transformed. The biggest issue is making sure the organizational procedure and culture is also transformed toward a more digital inclined ecosystem. So perhaps the speakers can chip in or throw in a comment on that. Does any of the speakers like to make a comment on Pedro's, on Charles's comment? Chris, Andrea?
I'm happy to chip in. That's Charles. That's a very good question. I think that a lot of what is happening is that nowadays a lot of executives are under pressure to sort of launch the digital transformation programs, but sometimes they just think is another kind of like checkpoint on their list of things to do and on their budget, and they don't sometimes many people don't understand that when any company or organizations undergoes a digital transformation, this is a company-wide effort that will touch each and every department within the organization. I've seen a lot of this particular, and I'm talking with companies that are transforming, not companies such as FinTechs or other digital providers that are born digital business, but I'm talking to those companies that are in the process of transformation. A lot of these projects are either born within the IT department or within the PMO department, if they have one, and oftentimes they're still perceived as a legacy, or not as a legacy. They're still perceived as a sort of a side business, and they're not perceived as something important. Just to give one example, I'm not sure if everybody knows Blockbuster, which used to be a business mostly in developed markets rather than developing markets. But basically, Blockbuster was the world famous chain of video rentals, and as a matter of fact, they were the first one to invent the first streaming platform years before Netflix arrived, and they thought that there was no part of their core business, and therefore they preferred to open more stores. And some years later, the founder of Netflix even tried to sell to them their own streaming platform, and still, so they had a second chance, and still they refused. So this is to say that when you undergo a digital transformation program, this is not only an effort of one department, but it's an entire organizational effort, and it has to really be perceived as that is the core business from now on, not just as another check on your list of things to do.
Thank you, Andre. Do we have any other comments? Chris, do you have anything to add? No. Okay, so we'll go to the next question. The next question is, we have actually two questions from Vijay. He says, how can fintechs help banks to transform, especially on APIs, AIs, and replace core legacy backend systems in a seamless way? And the second question is, how long is the minimum time frame to become digital to a certain extent in this environment? So, Declan, would you like to start, or Chris?
Okay, I will tackle the first question rather. how fintechs can help, legacy banks to become a little more digital through API integrations, etc. So, and I think Andrea and others have actually touched on this element, that there's need for collaboration, and it's not necessary for, let's say, a whole bank to just start from scratch. There are several strategies they could use. They could work together with fintechs to ensure that they integrate their systems and adopt new business models, like sort of B2B rev share models going forward. But I think this requires very critical alignment of one's, let's say, bank culture, organization, institutional culture for that matter, as well as just reflecting through their product offers. And like Andreas put it, digital transformation, I find it slightly more problematic even sometimes than starting from scratch, because it's just the question of how successful will you be able to totally transform your company to become digital. There are lots of changes that we'll go through, and the question is the company even ready for this type of changes? So sometimes efforts to digitally transform are not necessarily successful, and it takes more resources and more time. So as an alternative, working directly with, let's say, fintechs can be quite viable, especially once, let's say, banks have figured out what exactly they need to do. Then it will be easier to identify a fintech that they could collaborate with. And there are ways they can do that. So first is integration of systems through APIs that speak to one another, to enable certain levels of data transfer, etc. Or let's say product service successes. That's one way. The other way, banks could even acquire, some of these fintechs, especially if they're still small and it makes business sense. An acquisition strategy could be something that is useful. But as a matter of fact, banks must definitely collaborate with fintechs in order to access the markets and the value chains and the verticals a little more right now, as a matter of fact, moving forward. Thank you.
Thank you very much.
The second part of that question, if that'd be okay. So, when you talk about the time frame to digitalization, it's very difficult to say, because each organization is totally different. And, really, I want to thank Pedro for his presentation, because he really outlined a lot of the exactly what is happening in the market in different stages. And what I've seen, and what I was told when I was young, actually, about with the banks, is that every bank wants the latest and greatest second. Okay, there's very few banks that will do something new and different unless somebody's done it before, and most of that, I think, starts with leadership, and that's really where the big issue is with so many banks, is that you have C-level suites that are filled with guys that are near retirement. And why would they take a risk, right? Why would they take, a chance on something new, even if it might be the best interest of the bank long-term, when, they just have a couple of years to cruise out and be able to settle into their retirement. And then they're replaced by somebody who's also in the same position, and again, replaced by somebody in the same position. So it's really difficult in the traditional banking world for this kind of change to happen. And we've seen very few successful situations. A number of big banks have just gone ahead and Pedro pointed out this model, gone ahead and just started brand new from the ground up banks. And some have been successful. I would say several haven't been. But what happens also is that inside the bank, there is such an adversity to risk and innovation, those two things. Nobody wants to take a chance and nobody wants to try to do something new. And we've seen many banks purchase fintech companies. And I have to tell you, in my experience, that usually works out pretty well for the owners of the fintech company. But what happens when that company goes inside a bank or even a big financial institution is that they end up having to conform to that traditional thinking, and the innovation that made them attractive in the first place, the innovation that gained them the ability to be acquired, disappears very quickly, and they go into maintenance mode. So I think, you know, what we really need to see is what Andre and Declan both have also said, which is there needs to be more collaboration. Banks acquiring, or even big companies acquiring innovative fintech companies, usually spells the death of innovation. So it's a big kind of step and leap. And that's one of the things that I said earlier, why I think the potential, particularly in the African market, is so great to leapfrog, is there isn't that infrastructure that has been there for 20 or 30 years. There isn't the legacy systems that have been there 20 or 30 years that so many people feel that they need to protect because it means their job, that they need to protect because they're not ready to learn something new, or it's too late for them, or they need to protect it because that's the way we've always done it. So if you can collaborate with the fintechs and get the best of both worlds, where you let that company, you know, provide the innovation, and you give them the ability to make the changes inside, then I think that we can see some really great changes. And I think that the market in Africa and the time that I've spent the last bunch of years in many of those markets talking to people, that there's just so many great ideas and innovation there. And you have so many banks that are not tied down by legacy infrastructure, that there's, you know, clearly going to be a change in how those banks and institutions run compared to what will happen in Europe or the States, or even in some places in Asia where there's just too much legacy systems. So I think, you know, it certainly would pay for any institution to look at, for instance, what Pedro put forward with the different models. It would certainly pay to look at what Declan said about that collaboration and being able to work together, rather than, you know, absorbing these good, innovative and growing companies. So, you know, I know I kind of, there's not an answer to the timeline, because really, to me, it depends on top management. Like, you know, if top management is committed in the bank or the institution to making dramatic changes, and that's what needs to happen today, it can be done. We've seen a few examples. But what we've mostly seen is exactly the opposite, that there's no leadership from top management. They won't take the risk as leaders to make changes, and they really just want to see things remain the same until they can move on to their retirement. So it's kind of a sad situation in that respect. And, you know, the other thing that, of course, when we talk about banks and fintechs, is that banks still have a very strong position in that they're the only ones licensed to take deposits. And I really think that, you know, there needs to be some change in that area so that the fintechs can truly compete with banks. And this will force the banks to move out of their very comfortable, insulated arena that they've been working in for the last few decades. But that would be a big regulatory change.
Thank you very much, Chris. Just before we wrap this up, there's this idea that fintech has become not only an integral part of the entire electronic financial services business, but it's actually now leading the entire industry forward. And so I just want to hear from you. Do you share the same view with that? Hello, Chris. You muted.
I'm sorry, I missed. No, I missed the part of the question.
Yeah, okay. So I said there's the idea that FinTech has become an integral part of the entire electronic financial services business, but is actually now leading the entire industry. So I just want to hear from you if you perhaps share the same point of view.
Well, you know, certainly it's its own industry, fintech. But you know, again, like any business, you're dependent on your customers, and the bulk of the customers that the fintech companies are interested in are banks and financial institutions, as well as big tech organizations. And you know, your business really depends on how well you can make them see your vision and be able to grow. So it's a very interesting kind of marriage, let's say, between really kind of complete opposites. But you know, as we see as every day goes on, that it's needed much more. You know, that would be my take on that.
Thank you, Pedro. What's your take on that?
Can you repeat the question, please?
I said there's an idea that FinTech has become not only an integral part of the entire electronic financial services business, but it's actually now leading the entire industry. So I just want your take on that, if you share the same view.
Yeah, I would say that there has been quite an evolution on the way they are perceived, and also the word FinTech has also evolved over time. Initially, there was this idea that FinTech was going to take over the world and was going to beat every bank. Then there was an evolution towards, you know, FinTechs on their own, in most cases, probably are not able to be successful. So they need to cooperate with existing finance institutions. And now I think we are evolving to a third level, where I actually made the point in my presentation, where you actually see, and one of your colleagues mentioned about tech fin. So effectively, now we see technology everywhere. And I would say that the terminology fintech probably will end up disappearing, because we will not have a single financial institution, whether it has a license or no license, without using technology. So effectively, it will be an integral part. And we're going to see technology players specialize in particular areas, in particular verticals, which will help the financial institution, whatever shape it may have. Some of them will be very strong at gathering data and using that data, or converting that data into cash, into business, by using the tools like artificial intelligence or machine learning that everyone is talking about. Some others will be very good at dealing with issues related to anti-money laundering and KYC, which is also a big task which regulators now have pressured banks to do better and better, not only banks, but paying agents and all that. In particular for Africa, where you have the issue of dealing with the international flows, because Africa usually relies a lot on international payments and imports of goods. As you know, it has been hit by the US in particular, and the US dollar, because it is not able to actually prove that is actually doing a good job on the compliance side. So I think it's impossible to hire an army of people. So you have to go back to the technology tools that basically do follow the transaction and are able to help these banks. And that's a solution, obviously, for large banks that have basically they have written off this business just because they cannot cope with the complexity. And I think ultimately there will be an opportunity for some of these large players that left the continent to come back if they have the right tools to actually cope with the complexity of this nature. But I would say we will see more and more technology becoming an integral part. And we are already seeing some banks moving from an IT department to actually the IT being integrated in the different business areas. I think the big mistake every institution makes currently is to create the technology know-how under the IT. And we see the new challengers not having an IT department. They basically have business areas where IT is already embedded in the different products in the different sectors. So we see this marriage between technology and business, but one has to have the business understanding, and that's where we are converging now, because we see that there was a lot of initiatives coming from more of an IT side, and we see that sometimes they do not relate to the real business challenge. So we see that challenge has to also drive this disruption effectively. But to answer bluntly to your question, I think this marriage between technology and financial services is here to stay.
Thank you very much, Pedro. With that, we've come to the end of the questions. Before we take closing comments from the speakers, I just want to give the audience 2 more minutes. Maybe if they have questions, we can give them the opportunity to ask live. So the audience, if you have any question, you have 2 minutes to quickly identify, and then we'll give you the opportunity. 2 minutes. If we don't get any question, and then we'll just take the closing comments. Okay. All right. So far, we don't have any question from the audience. So let's just take closing comments from the speakers. The speakers, can you give us your closing comments on any of the topics we have discussed, starting from Declan?
Thank you very much, Osita. And again, it's a great pleasure to have been part of this fantastic panel. And it's a great pleasure to meet you, Andrea, Pedro, and also Chris, as well as Kamaku, who already left. For me, I think, and this ties actually to the last question that was raised, financial services, fintech is just an indicator that, you know, industries are adapting technology. And fintechs obviously cannot exist by themselves. We need, they're simply servicing other industries. And in Africa, there's a huge infrastructural gap. And if I can take a case like e-commerce, the reason why e-commerce isn't successful yet here is because of the infrastructural deficit, you know, proper addresses, proper roads, just the cost of moving products from point A to point B is so high. But, you know, the speed of transactions, which is enabled by technologies, is an indicator that, you know, there's growth happening. But there'll be more growth needed in these industries like logistics, for instance, you know, creation of more infrastructure, business models that promote, let's say, movement of goods from place to place faster. You know, that will simply make fintech grow more, and also technology become more ubiquitous. So I think it's quite exciting onto what business models will be playing out. But definitely for any organizations, especially financial institutions, traditional banks, fintechs, etc., to be successful and to stay afloat, then technology must be adopted as an integral part of that company, as opposed to technology just as an alternative strategy. Yeah. Thank you very much.
Thank you. And Andre? Are you muted, Andre?
Thank you to all the panelists and all the attendees of this seminar. It has been a very interesting and stimulating discussion. I think that in also like kind of echoing what Pedro and Chris have mentioned, I would like to kind of use a metaphor, which is actually a law of physics and chemistry, which is the principle of Lavoisier. And the principle of Lavoisier says that nothing is created, nothing is destroyed, everything is transformed. And why I want to say this is because that's how I see fundamentally the markets evolving. As Pedro mentioned, fintechs were thought to destroy banks. They were thought to take over the market. But actually what we've seen is are multiple layers of integrations, both vertical but also horizontal. And fundamentally, we're seeing that the ecosystem, the organism is shifting, and we're not seeing necessarily the destruction of old players as much anymore. I think that in general, why I'm saying this in particular, I'm looking at the relationship between banks and fintechs, is that I don't think that one or the other would prevail. I think I see this more, again, to use a scientific term, more of a symbiotic relationship. And I will see more and more banks become platforms, that they will have multiple integration with fintechs, because what is true and undeniable about a lot of the fintechs, or let's call them however we want, tech, fin, whatever, is that they can do one thing and they can do it very well. And banks sometimes are these behemoths, they're giants that they offer a lot of services, but they cannot specialize on one service in particular. So frankly, this is how I see the markets evolving, and this is how I see the direction going. Yeah, it would be a transformation, but fundamentally, yeah, it would be based on cooperation and partnerships between the different players.
Thank you, Andre. And Chris?
Yeah, also really enjoyed working with our panelists today, and it was great to meet you guys. You know, I'll start off with a little bit of the bad news first, which is I still see on the upcoming horizon that we're going to have, particularly in the developed world, a lot of economic problems, and a lot of it's going to fall on the banks. And the banks didn't cause this situation, but they're going to be really put through a very difficult period of time, which is going to affect, you know, everybody around us. And we're in a situation right now where governments are just printing money. They can't continue to do that. It's going to be very interesting on what happens because it crosses so many industries, and there are I think fallbacks and repercussions that we don't realize right now that are going to happen. What the good news is that I see this as speeding up the digital transformation. I see this as, you know, going to weed out some of the laggards in the industry. They're just not going to be able to survive. And very good point with the fintechs is that, yes, most of them are very good at doing one thing. They're actually better at the banks at that one thing than the banks are. And that can be such a big benefit if it's embraced by the banks. But we need the banks to really be much more open-minded, much more willing, and be able to innovate and embrace that innovation so that they can continue to be part of the ecosystem. I think that, you know, we're going to see, you know, some real transformation. I think that this market in particular, Africa in particular, it's the youngest average age of any continent. It's filled with people that are, you know, freshly educated, who have grown up with technology, who are embracing it, who have innovative ideas. And I just see so much that's going to come out of this market going forward, because there's not the same restraints that we see in so many of the other markets. So I'm very, very optimistic about what's going to happen in the next few years. And I'm really excited to see myself the transformation that's going to go on, you know, and I wish I was going to be around for the next 30 years so I could really see all the transformation, but I'll be really pleased with what I get to see while I'm seeing it, because it's something that I've always been very interested in. You know, innovation is really about the creation of economies. It's about the creation of wealth. Okay, without innovation, there's no wealth creation. So it's going to be an exciting ride. It'll be bumpy in some areas, but it'll be a roller coaster in other areas. So again, thank you so much for having me on the panel. Thank you, my fellow panelists. Really enjoyed being here with you, and a lot of your comments were really right on the target and very well put. So just pleased to be here. Thank you.
Thank you, Chris. Thank you very much. And then we'll take the last closing comment from Pedro.
Well, again, I will also like to say thank you very much for the invitation, and thank you for all the panelists. I think it was a great discussion. I would say that taking into account that we're talking about Africa, Africa has the benefit of, as mentioned by Chris, of being a very young population and eager to have change. And this is the ingredient to allow innovation to actually come forward in a much quicker way than probably more mature markets where the population is much older and averse to change. So I think Africa is certainly a continent that should be supported in that way, and where a lot of opportunities will come, because you can also leapfrog a number of older technologies the same way as we have seen in Asia, for instance. So I would say Africa can benefit from leapfrogging from older technologies that probably will be of no use or less use than new technologies. I'm talking about, you know, alternatives to the networks of MasterCard or Visa, alternatives to the typical way you do transactions by using blockchain. So there is a lot of innovation, and I would say Africa has proven with M-Pesa that it can innovate once it lets it innovate. And I think the point that Andrea made about regulation is critical. If you allow to innovate, then effectively innovation will happen, and I'm sure it will be a very interesting market to follow. But one should allow that to innovate. Just to close, I would like to make an observation about what just happened this week. Actually, it's a very fresh news on what not to do. Brazil, as you know, a large market, also young people. Recently, WhatsApp has enabled payments through their app. The regulator just stopped the WhatsApp payment system. Why? Because they are being pressured by the oligopoly of these large banks that control the financial system in Brazil, and they are losing money every day. Now they see they cannot cope with the challenges of innovation because they are with the old model, with very high costs and very high margins. They are the most profitable banks almost on the face of the earth because of the high interest rates they have had for a number of years and the high commissions they actually charge clients. So, I mean, if you get the regulator on your side, I think it will be and if the regulator understands this is for the good of the population, particularly the underbanked and the unbanked, I think ultimately Africa will be very well served with the technology ahead.
Thank you very much, Pedro, for that closing comment. With this, we have unfortunately come to the end of this section. I want to thank all the speakers very, very much for joining us in today's discussion and sharing their views on several topics we've discussed. And so just to let everyone know, we'll be having a pitch session where we gather different startups from different locations to pitch and compete. And at the end, the judges get to pick which startup is the best in the event. So it's happening on the 10th of July. And I do hope that every one of you will come join the event. Thank you very much again for joining us in today.
Thank you. It was a pleasure.
Thank you. Thank you very much, everyone.
Sita, also, thank you very much for moderating. You did a very nice job.
Thank you, Sita.
And enabled us as panelists to do a good job. Thank you.
Thank you.
Thank you.
All right, bye-bye.
Bye.